Hello there, I'm Erin Aid. This is Boom Bust, and these are the stories that we're tracking for you today. We're talking QE this afternoon, but this time in Japan. We'll tell you what QE means for investors and the Japanese economy. And Jim Rickards, Chief Global Strategist at West Shore Funds and Boom Bust All-Star, gives us his take on where he expects flashpoints to occur if oil prices continue to stay weak. Then in today's Big Deal, Edward Harris and I are continuing the discussion about Japan. It all starts this very second. Now, as a famous American philosopher once said, "Don't call it a comeback, I've been here for years." So who or what am I talking about? Not LL Cool J, but quantitative easing, of course. Now, just yesterday, I told you that QE was done, over, so long, farewell, and all of that. The Fed closed the door on its third round of balance sheet expansion via large-scale asset purchases. QE3 is officially history. But hold the phone, my lovely boom busters. As the Japanese have shown us, QE is an economic policy zombie that no amount of garlic or crucifixes can prevent from rising up again to work its magic on our global economy. Now, the Japanese made the catastrophic error of thinking that their economy was in the clear, and so they went ahead and raised the consumption tax for the first time in 17 years. They increased it from 5 to 8%. The last time the Japanese did this, the economy collapsed in a heap, causing a banking crisis and recession that ushered in the deflationary period that now besets their entire economy. Now, this is a second depressionary lapse that many economists compare to what happened to the U.S. in 1937, when the U.S. tightened both fiscal and monetary policy simultaneously. So, what happened this time? Well, spending plummeted, and with the advent of plunging oil prices, Japan is also at risk of falling back into deflation. The Bank of Japan must be panicked, so they reawakened the quantitative easing beast and unleashed it onto the hapless Japanese public on Hallows Eve, no less. Now, of course, stock prices went up because that's what QE is all about, asset prices. And Japanese shares zoomed up 4.8% on the QE announcement and are sitting at a 7-year high. One other nicety that this accommodative approach has is that it's cheapened the currency. The yen is now down to a 7-year low against the U.S. dollar. So what's the takeaway here? For me, the first and most obvious takeaway is that the Fed may want us to believe their balance sheet expansion is now at an end and that they're normalizing policy. But the truth of the matter is we don't know how robust the post-private debt credit crisis U.S. economy really is without the extraordinary support of the central bank. And Japan has sure shown us that QE has staying power, that's for sure. Now, the second takeaway here is that the pie is shrinking. Everyone is pursuing economic policies as if we're playing some zero-sum game. More for me means less for you. Now, the thing about that game, it's a tough one. It's that they create this self-fulfilling dynamic, a veritable race to the bottom, a dark and ghoulish outlook that I'm still hoping we can avoid. To talk about China, Russia, and oil, I sat down earlier this week with Boom Bust favorite Jim Rickards. Now, Jim is the Chief Global Strategist at West Shore Funds and author of the New York Times best-selling book, The Death of Money. It's an awesome book. You should definitely pick it up. Now, in this segment, I first asked Jim how far Chinese growth has to fall in order to make a successful rebalancing a possibility. Take a look at what he had to say.
China's about 10% of global GDP, so if it fell by half from the, let's say, the 7.5% range to maybe the 4% range, somewhere in there, that's going to knock, kind of 5 points off of a global GDP. So that's a lot. Now, but again, this will add to the deflation. The problem is I don't see the rebalancing, because the rebalancing is supposed to be from investment to consumption in China, inside China. The problem is most of the investment's been wasted. It's 45% of their GDP. If you start reducing the investment component, that has to, because it's such a large percentage of GDP, that has to go down faster then the consumption piece can come up. And if you have a credit crisis in China, that's going to ding confidence and make consumption even tougher. So it's hard to see how China gets out of that. They've been trying to cheapen their currency, again, back to the currency wars, but I think the U.S. has probably got limited tolerance for that. So there's sort of no, the thing is, Aaron, there's no good way out of this through monetary policy, because monetary policy cannot solve a structural problem. The whole world needs to restructure. Japan, the U.S., China, and Europe all need to restructure. Of those four areas, the only one that's actually doing the restructuring is Europe. That's why their growth is suffering, because that's part of the price you pay. But the U.S. and China and Japan are trying to pretend that everything's okay. But by not making the structural adjustments now, they're going to have worse collapses later.
Where will oil go if China continues to go away from infrastructure and export-led growth?
Well, China is becoming one of the world's largest oil importers. They may be at that point already. They have enormous demand for energy. Of course, they burn a lot of coal, but coal is, poison the air and poison the water over there, so there are limits on that. But if China slows down, they might use less. The thing is, energy prices move on three vectors. The three vectors are, one is basic supply and demand. So what are the industrial uses for industrial inputs, and what's the supply side? Supply side looks very good right now, and to the extent the economy is slowing down, that weakens the demand for it. There's some talk that maybe Saudi Arabia is purposely suppressing the price of oil to put pressure on the Russians to back away from their support for Assad in Syria. I haven't seen any direct evidence of that. I don't expect to. That would be the kind of thing that would be a very closely held secret between the major governments of the world, but I don't think you can rule that out. The other factors are, inflation, deflation. Well, we just talked about how the world's deflating, so that tends to put downward pressure. The third factor is geopolitical. Even with the Islamic State, the interesting thing about the Islamic State is they're pumping oil. There's all these trouble spots all over the Middle East, but all of them want to pump oil. We saw something similar happen in 1986 in the Iran-Iraq war. A lot of people said, oh, gee, two of the biggest oil powers are at war. That's going to cause disruption in supply and cause the price to go up. And I said, no, it's the exact opposite. When you're at war, you need the money, so you pump more, and it brings the price down. I think the price of oil went down to like $12 a barrel at that time, maybe a little bit less. So, so with all the turmoil in the Middle East, unless people start actually, blowing up fields and, sinking tankers, which is not going to happen because the U.S. military would prevent that, they would tend to produce more to get money to prop up their wars.
So, where do you expect flashpoints to occur if oil prices continue to stay weak?
Well, there are flashpoints all over the world. Obviously, the South China Sea, the geopolitical flashpoints would be, South China Sea, the Senkaku Islands between China and Japan, obviously Ukraine, Central Asia, Venezuela could blow up. So these are all potential problems. But I would say that we sort of see all of them. These things could get worse. Ebola is another one, the Islamic State. This is a long list, unfortunately. These things could all get worse, but they're all on the radar screen. The thing that I'm more concerned about that could really, cause a financial panic and cause the sort of house of cards to collapse is the thing that we don't see, the thing that we're not thinking about. That could be something like, an unexpected bank collapse or an unexpected failure to deliver gold by an exchange or a major broker, something more like an MF Global where it kind of comes out of nowhere, catches people by surprise, and starts a liquidity crunch. So I think that's probably more troubling than the geopolitical flashpoints, because at least we can see those and discount them to some extent.
Now, I understand bond markets are concerned because Venezuela may default. So if they did, given Argentina already defaulted, could there be contagion?
Sure. When the question is when somebody defaults, you can see the defaults coming. What you don't know is who are the creditors. You don't necessarily know that. You may have some information on that. So it's sort of like when AIG failed, the big loser wasn't AIG, it was Goldman Sachs. Goldman Sachs, was probably insolvent or close to insolvent at the time. And the bailout of AIG was really a bailout of their major creditor, which was Goldman Sachs. So the same thing is true today. When you see Venezuela collapsing, you have to say, well, okay, we know who the debtor is, who are the lenders, where's the AIG that's in line after Lehman, or the Goldman that's in line after AIG. What's the next domino that's about to fall? That's harder to know. So again, that's true all over the world. It does kind of remind you of the 1930s when these failures started popping up. People started going off the gold standard, defaulting on their debts, imposing capital controls, et cetera. And then there was a super catalyst with the failure of Credit Anstalt in 1931. But there were some warning signs ahead of that. I do see the warning signs today.
Any thoughts on Japan, Jim?
They've been in depression for 25 years, and if they don't make some changes, they'll be in depression for another 25 years. This goes, well, it goes back to what I was saying earlier. You can't print or deficit finance your way out of a depression, at least if you're wasting the money, which they do. You know, there are people in Japan who say, you know, the road in front of my house has been paved, you know, 5 times in the last, 10 years. It doesn't need that much paving. There are things that Japan could do structurally that would help. Cut taxes. Allow greater immigration, empower women, increase the role of women in their economy, break up some of the big banks, force some companies into bankruptcy, make improvements in their kind of very antiquated retail distribution system. There are a lot of things that Japan could do, but they're not doing any of them. So why would it change?
That was Jim Rickards, Chief Global Strategist at West Shore Funds and author of The Death of Money. Time now for a very quick break, but stick around because when we return, David Merkel, founder and president of Aleph Investments, is talking to us about buybacks and his top macro investing ideas. Then in today's Big Deal, Edward Harrison and I are continuing the discussion on Japan. And remember, you can see all segments featured in today's show on YouTube, youtube.com/boombustrt, and on Hulu at hulu.com/boom-bust. Now we got to go to break, but before we do, here are a look at some of your closing numbers at the bell. Don't go anywhere.
What are your thoughts on what's been going on in Washington?
Well, it's a mess, Larry. I mean, the whole country is being scoffed at and laughed at.
Enough is enough.
The media, the candidates, the corporatocracy, covering issues that actually affect you and me doesn't do too much for ad revenue.
Biotech agriculture giant takes on a 76-year-old American farmer based in Indiana.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
Breaking the set is mostly about alternatives to the status quo, but one that gave real alternatives a voice.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
You know that guy who wishes someone would spy on him? How about the woman who enjoys being lied to by her government? This citizen can't get enough congressional inaction, and this taxpayer wants the mainstream media to be more corporatized. While this person would rather eat genetically modified food, this one thinks our prisons are not crowded enough. And what do these people have in common? They don't exist.
Here in the House, about 100 of the 435 seats are considered in play.
They needed 39 seats before the end of the night.
59 Democrats, 41 Republicans. You can do the math at home. 50 seats, 55 seats Republicans need, plus 10 to get a majority. That's what they need.
Welcome back. Up now, we're bringing you part 2 of my interview with David Merkel, founder and president of Aleph Investments. Now, in this segment, David and I discussed how the top 449 companies in the S&P 500 spent $2.4 trillion with a T dollars on buybacks between 2003 and 2012. Now, David explained that what he thought was driving this whole thing and what that factor was. Take a look at what he had to say.
if companies are giving away a lot through stock options, a good value investor takes that into account and says, well, that's money going out the door for me that way. And so you make adjustments for it. I try to look at dividends plus whatever the net reduction is in the stock, and then take a look at the remainder to see, okay, where are they finding ways to add value with their free cash flow in other ways? You know, do they all the methods that I mentioned in the last minute? So it's, you know, are the corporate managements using the cash that they're generating from operations that are free to be used for investing? I prefer to see investing, then dividends, then finally buybacks if you're doing it at a price that's reasonable.
Right. It's almost like I wouldn't say personal austerity, but you know, company austerity. Did you really earn this buyback, or are you just doing it to keep? Is there growth in some way?
Yeah, and buybacks are good for corporate executives because, again, as opposed to a dividend, with a dividend, I mean, it affects your option prices versus doing the buyback, it does not. Now, granted, it's tax favored to do it through buybacks, but even then, I prefer having the dividends in my hands to try to reinvest because I may have better places myself to reinvest the money.
Yeah, there you go. You could do it better than they can, so why not?
Even with the taxes. Even
with the taxes. It's okay. If you're making enough, you'll figure it out. You know? So I want to ask you about your top macro views coming up and over the next few years, actually. So what are your favorite picks? And when I ask you, I mean sector-wise, in terms of, like, you know, interest rate environment and what will do well in the dividend play, things like that.
I think it's hard to be doing anything in fixed income these days. Yields are too low. I mean, the part of my portfolio that's done the best have been my long treasuries because they've gone up in price, down in yield. But those were only there as a hedge against deflation, and it's a deflationary environment, so I'm leaving that hedge on, much as I'm not crazy about it. Now, that said, it's been the part that worked. I like some of the emerging markets long term. I even like Russia. I even like Brazil. Even though these are messy places right now, current commitments could look good after 5 years. But this is not something that you go and do and think, by next year I'll be doing great.
Right, you're holding this for a second.
Right. I'll be holding it for years. I mean, that's my typical holding period is 3 to 5 years. So I'm happy with doing things like that. Beyond that, I'm just sticking to my knitting. Basically, it's very ordinary industries. It is companies that are well-financed, companies that are trading at a reasonable multiple of earnings and book, and that are producing free cash flow and using it properly. So, but that can be, again, relatively boring types of businesses. I thought of 4 in my portfolio, and to remember it, I thought of the word lens. So there's Lukoil, which is the Russian oil firm, trading at a price-earnings multiple of about 5. There is Ensco, which, admittedly, with oil prices lower, is not the best place. They drill for oil. I mean, they provide rigs to drill for oil. There is Navient, which is recently spun out of Sallie Mae and is not that well known of a company, trading about a price-earnings multiple of 8. They basically service student loans. And then finally, Sabesp, which is a Brazilian firm. They are the Sao Paulo Brazilian water utility. Stock price has been falling because they're having a hard time sourcing water, and a lot of people in Sao Paulo are going without water now. That's a problem that has to be solved.
Yes.
And if this problem is solved, the stock price will be considerably higher. Is there no risk here? No, there's risk here, but I'm willing to take some of that.
And they also have, if you just think about other macro things, the Olympics coming up. They're going to have to solve this problem. This will be fixed, So that's interesting as well. Now, you know, I want to ask you about equities.
Okay.
Now, you know, on the safer side of equities, do you see high dividend plays, you know, like stocks like Verizon, AT&T, things of that nature, as alternatives to yielding bonds?
Yeah, I'm conservative on this one because going back to periods when people were buying equities for income, they're equities. I mean, yes, these dividends can be cut. And even something that is seemingly reliable like a Verizon or an AT&T, well, the telephone companies are facing their own technological challenges now in terms of who wants to use their services. So that may not be as stable in terms of being able to generate cash flow as people think. But I see all sorts of people going after master limited partnerships, business development companies, REITs, and places where they say, well, I'm just going to get my income here through non-traditional means. There is no guaranteed return of principal. And I mean, granted, you can still get defaults out of things like this on a bond, but you have a greater chance of getting your money back at the end. So that is a valuable feature. And stocks are stocks. They will go up, they will go down. And right now, if I had to view the stock market as a thermometer, we're somewhere between the 80th and 85th percentile for valuations. There's more room to go down than there is room to go up at present.
Absolutely. And you mentioned REITs before. I'm hearing a lot about this. Talk to me about this in terms of an investment.
Well, in the long run, those who like to invest in REITs, it's better to buy the REITs that have lower dividends and tend to grow their dividends over time. Those REITs have tended to do the best. Okay. And so focus on managements that are trying to actually grow the dividend that they're paying you rather than giving you an immediate payout. And in this sense, equity REITs have always beaten mortgage REITs over the long time. And mortgage REITs invest in mortgages and other real estate debt securities, and they lever up, and then they try to get you a nice fat return, which works until you have a situation, the same sorts of situations that give the banks heartburn. And the REITs don't have as good of a funding base as the banks. And I mean, maybe half of mortgage REITs went out of existence in 2009.
There you have it. So when it goes bad, it goes really bad.
And REITs themselves have had their eras. People forget the history. REITs were introduced in the 60s, and then in the 70s, the REITs that had been created, a lot of them went out of existence. The same thing happened again in the late 80s, and then finally we had our recent period in the mid-2000s where a lot of REITs went out of existence because, I mean, many of them merged out of existence, but they aren't the most stable structures because you constantly have to be paying out your taxable income. 90% of your taxable income is going out regularly. Right. And so
that's not stable.
No.
Yeah, it's that simple. That's not stable. I want to quickly ask you, what do you make of index investing for individuals?
Index investing for individuals is an excellent idea.
I like it too.
Good. And it's a way of getting the average performance of the market with very little fees taken off, and it can be a way of basically, I mean, I like to think that I can outperform, and I have in the past, but do I know I'm going to do so in the future? No, I don't. So the same is true even of very famous investors. Are they necessarily going to outperform for you year after year? Well, what tends to happen is the ones that do tend to get more and more money, and then they stop because they have too much money to manage.
That was David Merkel, founder and president of Aleph Investments. Time now for today's Big Deal. Last big deal of the week, so let's make it a good one, and we'll talk about Japan. A little bit of Japanese going on here. So QE, it's big in Japan, Ed. They like it there. And I kind of thought that this was in Japan, metaphorically mission accomplished. Check. Right. Apparently not so. What's going on in Japan with QE? Dígame, por favor.
I think basically what happened is that they, as you were saying in your headline, they thought mission accomplished, but then, and so they put on this tax. First tax in 17 years on sales, that was an increase, and it was just a disastrous thing. Household spending plummeted. This whole thing about wanting to have inflation at a 2% target and get out of the deflation, that went in reverse. And so now the BOJ is like, what are we going to do? I guess we're going to have to ramp it up. And that's what we've seen. They've decided not just to buy more bonds, but they're also buying up other assets as well.
Now, what's interesting is there was a vote on this, obviously, and it was 5-4. So not everyone is super enthusiastic about this. What do you think this says about the lack of, it wasn't unanimous. So what does that say about where people stand on this at the Bank of Japan?
So, 5-4, I think, says that it just barely got by. And what it says to me, I think, and this is really important for other countries, is from a political perspective, the whole concept, theoretically, that you can have a central bank go in there and do whatever they want, and then they can, monetary is any and always
fiscal.
Inflation's any and always a monetary thing. Just go in there and print money or whatever it may be, whatever you want to call that. It doesn't really work. So at the end of the day, there are political constraints to this. Even within the Bank of Japan, we're seeing that 5-4 is all they could get for this particular deal. And this is always going to be the case. Fiscal and monetary stimulus are not always politically favored, and you can't just go out there and do this kind of thing and expect it to work. So at the end of the day, you have to deal within the constraints, both politically and economically.
So basically what I'm hearing from you is that you don't think that trying to boost inflation via a central bank is a good aim for a central bank to have, no?
Well, yeah, I mean, I wasn't even saying that at that particular juncture, but definitely I agree with that. I think that in this particular point, they were trying to boost inflation. So they had deflation, so they said, let's get inflation up. Inflation is a bad thing, we're always told. And yes, it is if it reduces spending power. What they're doing is they're saying, you wage earner, go out and make the same wages that you did before, but everything will cost more. How is that going to increase spending? How's that going to make the economy better? The only way that you're going to be able to increase spending is if inflation's going up because GDP is going up, because people are making more money, et cetera. But if people are making less money and you're taking more money away from them through the inflation tax, that's going to be negative for the economy.
It certainly is. So obviously you gave, yesterday we talked about QE as well, and you gave it a big boo, thumbs down.
Right.
Why? I mean, I think I know your answer, but I'm curious, why specifically, if you can bullet point it?
Yeah, I think that the reason that QE is bad basically is because it's really about credit, and it's about any sort of thing that it changes. It's not about actually giving people more money, as I just said with the whole thing with wages. So at the end of the day, it works through the credit process, works through asset prices, et cetera, and ultimately that's very distortionary. The market is sending signals for capital in the economy to be allocated in one way or another, and then the Fed is going in and changing that by fiat. And we can only expect that that change is going to have deleterious effects on the economy over the longer run. The hope is that the resource misallocation won't be so bad, and that the boost to the economy will be enough so that over the longer term it will be better. But what we've seen is that ultimately when these games are played, we end up in credit crises like the one that we had in 2008.
Do you think we're just going to see more of that?
I think that we're just going to see more because ultimately the private sector is too indebted to be able to go out and spend more and to boost credit more. They really need to have more money in income and wages.
Absolutely. Ed, thank you so much. And I sadly feel that this will not be the last time we talk about quantitative easing. That's for sure.
The U.S. is coming next, probably.
There we go. Given that it just ended yesterday, or the day before yesterday. Anyway, that's all for now. Thank you so much for watching. And please, we love hearing from you, so drop us a line on Facebook at our Facebook page, facebook.com/BoomBustRT. And please tweet at us at Aaronade, at Edward, I know your name, Edward NH. From all of us here at Boom Bust, thank you so much for watching. Have a wonderful weekend. Bye-bye.